Hey fellow REIT investors, welcome back to the channel. Today, we're looking at a REIT that's not been in the limelight, but perhaps it should. It's small, it's quiet, and it had a rough start after its IPO. But lately, it's been delivering stable, growing income in a challenging environment due to the nature of its assets. And this REIT is called United Hampshire US REIT, or UHREIT, and it's focused on one very specific part of the market: grocery-anchored retail and self-storage properties in the US. I know what some of you might be thinking. UHREIT is small, its sponsor is not well known, and many income investors tend to give these kinds of REITs a pass. And that's fair, but I'd encourage you to stay with me on this one. Because despite its size, UHREIT is a rather unique animal in the S-REIT space, and you might just find it more interesting, and possibly more resilient, than you expect. So in this video, I'll walk through what UHREIT owns, how its financials have quietly improved, what risks you still need to watch, and whether I think it deserves a place in a satellite income portfolio. As always, let me remind you that this video is for informational purposes only and not financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. I own some of the REITs discussed, but what works for me might not work for you. Let's get started. UHREIT at a glance. United Hampshire US REIT, with ticker ODBU, is a Singapore-listed real estate investment trust that was listed on 12 March 2020, meaning it has been publicly traded for almost 6 years. Its core investment strategy is straightforward: to acquire and own stabilized, income-producing U.S. properties that are anchored by grocery and necessity retail tenants as well as modern, climate-controlled self-storage facilities across the United States. Many investors may not have taken notice of UHREIT with a small market capitalization of slightly above $300 million. To make matters worse, U.S. REITs have taken on a bad reputation due to the issues relating to U.S. office REITs listed in Singapore. But for yield-focused investors, it quietly ticks some interesting boxes. What does UHREIT actually own? United Hampshire US REIT has a very specific focus: income-producing real estate in the U.S. that caters to non-discretionary spending or essential services. As of the latest update, the REIT owns a total of 22 properties across 8 U.S. states, comprising 20 grocery-anchored or necessity-based retail centers, and 2 modern, climate-controlled self-storage facilities. Together, these properties span approximately 3.6 million square feet of net lettable area, and have a total portfolio valuation of about $751 million. Geographically, the assets are located primarily in suburban communities along the U.S. East Coast, in states like New Jersey, Pennsylvania, Florida, and North Carolina, areas known for dense populations and resilient consumer spending. These assets are not flashy, but that's exactly the point. The idea is to generate steady, recurring rent from businesses that remain relevant in every economic cycle. That includes tenants like supermarkets, dollar stores, pharmacies, laundromats, and long-term storage providers. This focus on essential usage gives UHREIT a different risk profile from office or luxury mall REITs, one that's closer to a utility-like cash flow model than a cyclical one. Freehold advantage: why land tenure matters. Beyond the type of properties UHREIT owns, one of its biggest structural advantages is that 97.9% of the portfolio is on freehold land. That means the REIT has outright ownership of the land under nearly all its properties, with no ticking lease clock or need to negotiate costly extensions. This is especially important in the context of long-weighted average lease expires and defensive rental income. If a REIT has long-term tenants but the land lease is running out, the economics still deteriorate, because the terminal value of the asset declines as the lease shortens. And in such cases, extending the land tenure isn't cheap. A prime example closer to home is Keppel DC REIT, which in 2025 announced a 350 million Singapore dollars payment to secure a 10-year lease extension for its Singapore data center campus at Genting Lane. The asset had been flagged earlier for its short land lease, which had already begun impacting investor confidence and long-term valuation. Even though the data center was operating smoothly, the short lease created a capital structure and valuation overhang that had to be resolved, at significant cost. That case illustrates why freehold land provides not just valuation resilience, but strategic flexibility. For income investors, it means lower reinvestment risk, fewer surprises, and longer economic lifespans for each property. In UHREIT's case, This freehold structure enhances the quality of the 7.5-year average lease duration. You're not just receiving rental income for the next few years, you're holding real estate with permanent underlying tenure, which can be refinanced, sold, or redeveloped in the future without worrying about lease decay. That kind of control is rare in Asia, and it gives UHREIT a quiet but meaningful edge. Tenant mix and anchor quality, concentration risk, but mitigated. UHREIT has clear tenant concentration risk. Its top 10 tenants contribute over 50% of base rent, and a large chunk of its portfolio is anchored by grocery stores. Normally, that kind of reliance on a few major tenants raises red flags. If one anchor fails, the impact on rental income could be severe. But in UHREIT's case, this risk is meaningfully mitigated by two factors. First, grocery-anchored retail space remains highly sought after. Supply of new open-air centers in the U.S. has been extremely limited in the past decade, and the sector continues to attract institutional buyers. This strong underlying demand means that even if an anchor were to exit, the space is unlikely to stay vacant for long. Leasing momentum across the sector remains robust, supporting high occupancy and stable rents. Second, the nature of the anchor tenants themselves is defensive. Grocers and necessity-based retailers are less affected by e-commerce and economic cycles. Shoppers still prefer to buy perishables in person, and many grocery chains have integrated online fulfillment into their physical stores. This gives their locations long-term relevance and operational stability. So while the concentration risk is real, it's important to look deeper. These are anchors in a resilient, essential category, operating in a tight and competitive leasing market. That combination makes the risk far less concerning than it first appears. Representative property examples, grounding the story in real assets. To really see the type of assets held by the REIT, let's take a closer look at a few representative assets that bring the investment thesis to life. First, there's Upland Square, a dominant open-air power center located in Pottstown, Pennsylvania. Spanning over 403,000 square feet of net lettable area, it serves a dense suburban population of more than 110,000 within a 5-mile radius. The property enjoys a 99.4% committed occupancy rate, with anchor tenants like Giant Food Stores, Ashley Furniture, TJ Maxx, and Burlington collectively occupying more than 2/3 of the leasable space. The presence of discount and essential retailers aligns closely with UHREIT's strategy to focus on necessity-based spending with tenants that continue drawing footfall even during economic slowdowns. As a 100% freehold property with built-in rental escalations, Upland Square offers both security and gradual income growth. Next, Hudson Valley Plaza is a freehold regional power center located in Ulster County, New York, with a net lettable area of over 428,000 square feet and a committed occupancy rate of 94.9%. Anchored by major national retailers including Walmart, Ashley Furniture, and PetSmart, with Dick's Sporting Goods set to open in 2026, the property is built around tenants that cater to everyday essentials and value-driven spending. Developed in the late 1990s, the center comprises 3 buildings strategically positioned near multiple highways, making it accessible to surrounding retail and residential catchments. With a weighted average lease expiry of 8 years and 7 tenants, the asset delivers income stability while showcasing the REIT's focus on durable, traffic-driving retail formats. Finally, Carteret Self-Storage is a modern, freehold facility located in Carteret, New Jersey, offering 74,175 square feet of net lettable space with an occupancy rate of 93.2%. Developed in 2017 and professionally managed by Extra Space Storage, one of the largest self-storage operators in the U.S., the property comprises a 4-story main building and 3 single-story structures clad in corrugated steel. Designed for both security and convenience, it features keypad entry, 24/7 surveillance, climate-controlled units, individual locks, and a staffed office with a retail component. Strategically positioned just 15 minutes from Newark Liberty International Airport, the facility enjoys excellent connectivity. Together, these assets are not glamorous shopping destinations, but they are strategically located, serve high-need neighborhoods, and are anchored by tenants with sticky, defensive business models. And in an income-focused portfolio, that kind of boring is exactly what we want. Sponsor quality: are they willing and able? Any REIT, particularly one operating overseas, needs a credible, capable sponsor to guide operations and protect unitholder interests. In UHREIT's case, The REIT was launched with the backing of UOB Global Capital LLC and the Hampshire Companies LLC, creating a blend of Singapore financial pedigree and U.S. real estate operating experience. Here's what that mix means. UOB Global Capital, affiliated with UOB Group in Singapore, brings institutional structuring, capital markets know-how, and a track record of investor stewardship, an important anchor for Singapore-based unitholders. The Hampshire Companies, headquartered in New Jersey, is a private real estate investment firm with over 60 years of experience in U.S. commercial property markets, particularly in grocery-anchored retail and self-storage sectors, the exact verticals UHREIT operates in. This sponsor combination gives the REIT two things that are especially important for smaller foreign REITs. Access to a pipeline of suitable, stabilized assets. UHREIT's past acquisitions, like Dover Marketplace, reflect this sourcing advantage. Operational confidence in managing properties that span multiple U.S. jurisdictions, including leasing standards, property tax codes, and tenant retention strategy. So far, the willingness of the sponsor has not been well tested. Even though the REIT's unit price fell sharply during the IPO plunge in early 2020, the sponsor didn't have to come in with bailouts or loans, but possibly could have supported investor confidence with its on-the-ground knowledge and market experience. Still, let's be realistic. Unlike sponsors such as CapitaLand or Mapletree, who are deeply incentivized to protect their REITs due to their larger ecosystem of asset recycling and fund management, the United Hampshire sponsors do not have as much at stake. Their shareholdings in the REIT are constrained by U.S. tax rules that discourage holdings above 10%. This naturally limits their alignment compared to the large Singapore REIT sponsors. So while the sponsor may be able to act when needed, the scale and nature of future support remains uncertain. Financial performance, DPU growth, falling interest costs, and a clean capital structure. UHREIT's Q3 2025 results reflect steady execution and a quiet turnaround in its income story. Gross revenue rose 1.4% year-on-year to $18.1 million, and net property income grew 5.7% to $12.7 million, despite the impact of asset divestments. More importantly, distributable income rose 15.5%, driven by contractual rent escalations, improved leasing, and lower interest expenses. DPU for 1H 2025 was $2.09, up 4% from the year before, marking a second consecutive period of growth. This DPU recovery is underpinned by falling interest rates. UHREIT's trailing 12-month average interest rate has declined from 5.21% in Q1 to 5.06% by Q3, thanks to the U.S. Fed's rate cuts. With 21.5% of debt, of about $65 million on floating SOFR rates, the REIT stands to benefit further in 2026 as monetary easing continues. These savings are already supporting stronger distributions. Capital management remains prudent. As of Q3, gearing stands at 38.9%, with interest coverage at 2.6 times, healthy levels that give the REIT breathing room. The refinancing of major loans means there are no significant maturities until 2028 effectively, since the mortgage loan due in November 2026 can be covered by the recent refinancing. This reduces refinancing risk and helps protect unitholder income. Overall, UHREIT's financial picture has turned a quiet corner, stabilized operations, improving DPU, and lower borrowing costs, a rare combination in today's environment for U.S. REITs. That IPO plunge, and why it's no longer the whole story. If you followed UHREIT from the start, you'll remember that it had a rough beginning. After its IPO in March 2020, just as the pandemic sent markets into a tailspin, UHREIT's unit price fell sharply, dropping over 40% from its IPO price of 80 US cents within the first year. That decline wasn't just about COVID-19. It reflected deep market concerns around the viability of U.S. retail, especially strip malls, in an era of lockdowns and e-commerce disruption. But 3 years on, that original thesis has been challenged, not by commentary, but by operational results. Most crucially, the big issue that drove the IPO plunge, fear of collapsing retail cash flows, has been addressed. Tenant retention stands high at 90%, and many anchor tenants are on long leases of 10 years or more with rental escalations built in. The REIT has also trimmed non-core assets and kept gearing manageable at 38.9%, with a clear refinancing roadmap. So yes, the post-IPO chart still looks ugly. But the business underneath that chart has moved on, and is now offering consistent, stable income with a clearer path forward. If you're judging UHREIT solely by its pandemic-era stumble, you may be missing the turnaround that's already happened. Risks to watch, still worth monitoring. No REIT is without risk, and UHREIT is no exception. But the good news is that these risks are fairly well understood and manageable, especially if we're building a diversified portfolio. Here are 3 that deserve attention. First, currency risk. UHREIT earns and pays distributions in US dollars. For Singapore-based investors, this introduces US dollar to Singapore dollar exchange rate fluctuations into our returns. While the REIT's underlying performance may remain steady, our dividend income could be higher or lower depending on where the currency moves. This isn't a flaw in the REIT itself, it's simply part of investing overseas. If we want geographical diversification and exposure to developed market real estate, this currency exposure is inevitable. The way I manage this is by not overloading any single foreign currency REIT and viewing it as a long-term position where the currency effect evens out over time. Second, concentration risk among anchor tenants. UHREIT's tenant mix is deliberately focused around large format retailers, and several properties have a high percentage of income coming from a single anchor. Tenants such as Walmart, Lowe's, BJ's Wholesale Club, and Home Depot account for a significant share of rental income across the portfolio. The good news is that these are well-known, financially strong tenants, many of them publicly listed and among the top national chains in the U.S., but that doesn't completely remove the risk. A major lease expiry, strategic closure, or store rationalization could create temporary vacancies that are hard to replace quickly. Because UHREIT invests in suburban strip centers where anchor stores drive footfall, any disruption here would affect not just income, but also the smaller tenants that depend on anchor traffic. So while the anchors are solid, the risk is in the level of dependence on them. Third, evolving competition and retail dynamics. UHREIT has smartly positioned itself in the essential retail space. Tenants like grocers, gyms, auto parts, healthcare clinics, and other necessity-based trades. But even essential retail is not immune from competition. Big box retailers are constantly evolving, and online giants like Amazon continue to reshape U.S. consumer habits. While it's unlikely we'll buy groceries purely online anytime soon, it could slowly chip away at the market share. Also, the competition within the local catchment, especially from newer retail centers or mixed-use developments, can draw footfall away if the tenant mix isn't refreshed. Fortunately, most of UHREIT's assets are in dense suburban corridors where land supply is constrained and existing tenants often renew. In short, these risks are real, but not deal-breakers. They're the kind of risks that come with owning physical retail properties in a mature market. As long as the sponsor continues to manage these dynamics actively, and investors stay diversified, they can be worth taking on for the yield and stability offered. Before we move on, if you found this breakdown useful so far, do subscribe and give the video a thumbs up. It is the best way to help the Dividend Uncle. And if you want deeper dives like this, early access to ideas, or just want to support the work I do here, consider becoming a channel member, just like what Julian Tan, Hardev Singh and Tiong Peng did. Alright, now back to UHREIT. The Dividend Uncle's take. United Hampshire US REIT isn't the kind of REIT that dominates headlines. It doesn't own sprawling integrated commercial complexes or high-tech data centers, but what it does own is a tightly focused portfolio built around things people need: groceries, personal storage, and daily essentials. And in a dividend investor's toolkit, that matters. Occupancy is high, lease terms are long, and the rental income has been remarkably stable, even during times when other retail REITs saw more turbulence. Add to that a yield that's consistently above the market average, and you've got a REIT that delivers a compelling income proposition, without relying on financial engineering or overly aggressive asset expansion. That's why I see UHREIT as a strong satellite portfolio candidate. Not a core anchor, but a complementary position that brings higher yield with defined trade-offs. And here's how I'd approach it personally. I have initiated a modest allocation, sized for satellite exposure rather than core holdings. That means this REIT earns a place in the income sleeve, but not one that dominates portfolio risk. I'd track 2 key indicators: lease renewals and tenant performance. And because distributions are in USD, I'd continue to keep a lid on the size of my overall US dollar exposure. In short, UHREIT is a REIT I would own, but with clarity on what it offers, a stable yield engine with essential retail exposure in a mature market. The returns won't be spectacular, but the income durability, when paired with the right portfolio sizing and monitoring, can be very useful. So that's my full take on United Hampshire US REIT. If you enjoyed this video, give it a like, share it with someone who's building their dividend portfolio, and don't forget to subscribe for more REIT and income investing content. Until next time, happy investing.